I think that Wall Street has been distracted by the US election in the last 2 months. In fact, they have been dismissing signs of cracks in the economy. People like to describe the economy as strong, that Trump inherited a strong economy. But I actually think that Trump inherited a very shaky economy, and the labor market is still cooling.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. The last time today's expert was on the program back in July, she was concerned about rising unemployment. Is she still as worried about it as we prepare to enter a new year with a new administration taking over? Well, to find out, we've got the good fortune to talk today with Dr. Anna Wong, Chief U.S. Economist for Bloomberg Economics. Prior to her current role, Anna also worked at the Federal Reserve Board, the White House Council of Economic Advisors, and the U.S. Treasury. Anna, thanks so much for joining us today.
Thanks for having me again, Adam.
Oh, such a pleasure. Really appreciate you joining us here on Thanksgiving week. I'll try to use your time very respectfully, so let's just jump right in. Got a number of questions for you, but if we can just start with a general one, I like to kick these off with. What's your current assessment of the global economy and financial markets?
I think in the past 2 months, most of the market's moves have been driven and focused on the U.S. election, and and by that I mean it's actually there are both pluses and minuses. So on the plus side, in the past 2 months, everybody the markets have been pricing in what a Trump administration would look like, and a lot of that pricing has been manifested in higher inflation compensations in the forward-looking, for example, one year CPI fixings. So people were thinking that the Trump would be inflationary, and that seems to be almost like a consensus trade. And also, as a result, the dollar also has been appreciating very briskly in the last 2 months in anticipation of tariffs. And also the long-term yields have been, from September when the Fed cut Fed funds rate by 50 basis point, 10-year yields has risen by 80 bips since then, from then to November until this weekend, where Scott Bessent was announced to be the Treasury nominee. Now we've seen finally starting to see the 10-year yields just coming down on the back of this personnel announcement. So I think that as of now, the current stance is, I think the current stance is that the markets is now refocusing on what the plausible policies would look like under the Trump administration, given that now we have newer information based on the economic personnel that is going to be part of the administration. And so far, we have been very light on economic announcements under Trump. And I think we're beginning to see the trickling of who is going to play a role. And Scott Bessent is clearly the first of these people. We still don't know what role Lighthizer, the trade hardliner, will play in this administration. We also don't know who the NEC, National Economic Council director, would be. And those are all very, very important personnel that could determine how Wall Street would react, would pare back this Trump trade that we have seen in the last 2 months, and that would be kind of like a key driver of how market would look like, 2 months from now.
All right. Well, look, so as you said, the election had been in the driver's seat. Now that uncertainty is resolved, right? We know that Trump's the president-elect. Now, I did want to ask you about some of his cabinet picks. And so in a moment, I'm just going to ask you for your reaction to Bessent as a pick, whether you think it's good, bad, and different. And also if you can, if that gives you any sense of what we're more likely to see from Treasury with him running it, that would all be great. But before there, we know the main like tent poles of what Trump ran on from an economic standpoint, right? Tariffs, at least the threat of tariffs, right? His tax policy definitely seems to be, let's get rid of as many taxes as we can on the campaign trail. we talked about we're not going to tax tips, we're not going to tax overtime, and then near the end we heard, okay, we're going to do away with the income tax maybe at some point. Obviously, he ran on a platform of we want to gut the size of government bureaucracy. We have the whole DOGE, Department of Government Efficiency Department, that now Musk and Ramaswamy are going to run. And then, big things like deportations, right? Potentially millions of undocumented people, many of whom are working in the economy just under the table. But, so all of those things will have an economic impact. I'm just curious, if you and your team at Bloomberg have given some thought to this, and when you look at those key tent poles, what do you think that means for the economy going forward?
Yeah, most definitely, Adam. So we have considered the, in fact, in extreme details of these things. So tariffs, deportations, DOGE, those are things that don't usually happen, right? Those are almost like before the election, most people think about it theoretically, and now that Trump has won, the focus has become what are the details, and the details are what matters from a forecasting perspective. So, for example, on the trade war front, so I think economic textbook 101 would tell you tariffs would be inflationary, and that's like most people's gut reaction, right? But I think that reflects, glossing over the details, a lot of details, in fact. So in the first trade war under, in 2018, it's pretty clear that it was not net inflationary, right? And I think that is actually a pretty widely accepted um, um, takeaway from serious people, even from, there are published papers by former World Bank chief economist Penny Goldberg, who talked about how the trade war had a minimal impact on GDP and inflation. And I think people really need to look into why it was that it was not inflationary in 2018. And usually there are two explanations. Number one is that inflation expectations was anchored at that point, and the economy actually is seeing under 2% inflation, and therefore firms were not able to pass on the higher costs from tariffs to consumer prices. And that is usually the explanation. And most people today would say, well, inflation has been overshooting 2%, so inflation expectations may not be as anchored, and firms will more likely pass on the cost to consumers. However, there was also a second explanation, and I would say that it's an underappreciated explanation, which is that the first trade war was the products that the administration decided to impose the tariffs on is not randomly chosen. It's not like, okay, we're gonna do 25% randomly choose product. No, it was actually then the Council of Economic Advisors consulted with USTR and got together and come up with a list that tries to minimize the impact on inflation. So the idea is that, in fact, all economic models will show that the tariff, if you put on tariffs on intermediate and capital goods as opposed to consumption goods like your iPad, your iPad. I was going to say iPod, which is so 2000s, but iPads, those would be consumption goods, right? But if you so if the tariffs is on intermediate and capital goods, then the dollar appreciation in response to tariffs would actually impact would lower prices on consumer goods more than it raised prices on intermediate goods, because you know so as a result that the margin of adjustment from tariff won't be on inflation, but rather it would be on lower employment and a lower firm profits. So I'm not saying that a trade war is positive. I think there's only a very narrow slither of a scenario where a trade war would be on net positive for the economy, which is like it really is require everything to go, which is like a low probability event. Most likely, I think that a trade war would be hitting on employment, worsening the unemployment outlook. And I do think that the people in the second Trump administration would also think about prioritizing the tariffs on intermediate goods and capital goods, just like in the first trade war, to minimize the inflationary impact. So I think the part of the Trump trade where people are betting on highly inflationary impact from tariff, that might be that I don't see it as a sure thing. In fact, I that's not even my baseline. I think that a trade war, so my timeline for a trade war would be that there would be some minor escalation in after summer of 2025, but most of the escalation would be in 2026. And I actually have in I have upgraded our inflation outlook for 2020, late 2025 in response to just a general, the animal spirits pushing up, supporting the economy, and also some of that 2025 tariff in our baseline are on consumption goods. But then in 2026, I think on net, the net negative impact of tariffs on firm profits and employment would generate a net disinflationary force on the economy. So that's that's my view on trade war.
Okay, wow.
Yeah.
So net deflationary over time. Let me ask you this, because I know you, as I mentioned in the intro, you've served in past presidential administrations. So this is a world you're very familiar with. Do you, in your modeling, do you expect the Trump administration to actually implement tariffs, or is it more wielding the threat of tariffs to negotiate a better trade deal for the US?
Yeah, I think Trump really acts like how he acts like in The Apprentice, that program, that TV program on NBC
Sure.
back in the 2000s.
Yeah,
He
you're
likes
fired.
the Yeah, or he likes to sit back and watch his cabinet uh, officials argue and banter with each other. And very much he governs with a team of rifles. And so now we are starting to see who the economic key players would be in his administration. And I would say that so far it seems pointing to the direction of using tariffs as a negotiation tool as opposed to what a lot of people thought he would do, which is just blanket, untargeted, undiscriminatory increase in tariffs across the board. Because so far, both Ludnick, who will be heading commerce, and interestingly also heading USTR, as well as Scott Bessent, have described the use of tariffs as a leverage and negotiation weapon. And where's the people who are more hardliners on tariffs, like Robert Lighthizer and Peter Navarro? So far, we have not seen them, playing a role in the oncoming administration. In fact, the most influential economic positions are going to the two individuals who seem to be in favor of gradual and sequenced escalation in tariffs. And as fast as those tariffs would be imposed, they could also be de-escalated rather quickly. And
Mhm.
that is entirely consistent with the first Trump administration use of tariffs as well.
Okay. So just to be clear, your default model doesn't necessarily see a bunch of actual tariff implementations, nor does it see a lot of inflation coming from this. In fact, you're saying sort of net disinflation.
I
So
do,
that's
sorry,
fair.
Adam, to
Yeah.
be clear, in my baseline, I do have tariffs increase. So as opposed to Trump's promise, which is 20% universal tariffs increase,
Mhm.
as well as 60% on China. In my baseline, I have uh, tripling China's tariffs. So currently, China's tariffs is 12%. I have it going up to 36% by the end of 2026. I also have the rest of the world intermediate goods going from 1% to 3%. So on aggregate, I have tariffs going from today's 3% on all US imports to 8%. So that's short of Trump's 20% promise, but it's also, not negligible. And the reason why I think that there will be tariffs is that they need the revenues that a lot of people in this administration view tariffs as a source of revenues to partially finance the extension of the Tax Cuts and Jobs Act.
Okay, thank you for the clarification. And yes, you are expecting more tariffs, but not the aggressive,
Yes.
headline ones that have been sent. If you can, then can you explain real quickly? Because there's been a lot of back and forth in the media that Trump doesn't understand tariffs because it's the consumer that's paying, it's not the other country that's paying. So can you explain that
Yes, yes.
how it's a source of revenue for the government?
Right, right. So I think the language that people have been using to explain the tariff revenues, who borne the cost of tariffs, has been very loosey-goosey. In
Hmm.
fact, so first of all, fact number one, is that importers seems to be bearing the cost for tariffs in the first trade war. So that was what caused a lot of people to say U.S. consumers are bearing the cost of the tariffs. There's 100% pass through. So, but that's importers, right? But when people talk about consumer prices, that's not the same as saying um, tariffs are inflationary, because what happened is that importers, yes, they pay more, so then they have to decide whether they are going to pass on all the costs to the next chain, right? The wholesalers. And the wholesalers in turn have to decide whether they're going to pass on the cost to the retailers. And what happened was that um, between the wholesalers and the importers, they basically absorbed all the costs through profit margins hits. And of course, there's
Hmm.
also sectoral, reallocation. Some sectors which face more elastic demand saw a bigger hit on profit margin. Some sectors that saw a more inelastic demand get to pass on the cost. So it's like the tariffs will certainly change the relative prices, but on net, what happened is that the consumers, which are in terms of CPI, it's not showing up in the CPI because those margin hits, those price increases have been absorbed through the margin hits, even by the upstream sectors.
Okay. All right. Well, look, so that's tariffs. If we just look at some of the other policies, right, potentially lower taxes, potentially gutting government bureaucracy, again, the deportations, et cetera. What do you expect, like in your modeling, what is the net impact of that? Do you see this as being more stimulative to economic growth in a Biden administration, or do you have a different outlook?
Yeah, so on the deportation side, we have been our modeling suggests to us that the surge in immigration in the last 3 years was not really disinflationary. It's actually minorly inflationary, but on so that's the impact that we have estimated for the economy. So in reverse, if the deportation is focused on the new migrants, because maybe in terms of the implementation of the deportation policies, it one question is how do you identify them, right? And so
Hmm.
identification is one of the challenge. And if the identification process means that it would be the ones who arrived post 2022 who would be easier to track, and they would be the first wave being deported. It would be, our model would suggest it's actually net disinflationary, but only minorly because
Okay,
it actually cost money to deport immigrants.
sure.
In fact, that one of the estimate out there is 200 it takes $200 million to deport 1 million of immigrants. So that actually nets out with the demand effect of an immigrant. So if you, for example, a back of the envelope calculation is the New York City, gives the new immigrant $400 per week on food and utilities, right?
Hmm.
That actually nets out close to 20 billion per 1 million. That's like, about 20,000 per head. So the increase in hiring of ICE agents and lawyers and all that, the increased demand of those services in response to this ramp up of deportation actually will offset that kind of demand effect from the immigrants. So on the demand side, we see it kind of netting out, and on the yeah, so I would say that deportation should not play a key role on either inflation or GDP side. And then on Doge, I think Doge is actually a sleeper, uh, could be potentially a big thing that Wall Street isn't pricing in. So I think the two things that Wall Street is not pricing in is Scott Bessent's promise of cutting fiscal deficit to 3% of GDP by 2028, and also Elon Musk and Vivek Ramaswamy's promise of cutting fiscal spending. Because if you take that promises um, um, on face value, they could definitely change the trajectory of the fiscal debt to GDP ratio, and
Hmm.
that could lower the long-term Treasury yields, which could be quite stimulative on the housing market. So I think the Republicans' vision of the economy is that they have to cut government spending, free up resources for the private sector to take the reign of driving the economy through deregulation and then through lower energy prices, which should boost productivity. That's the vision they're trying to achieve. It is very difficult to achieve for sure. And they're thinking of financing this partially through tariffs and through higher growth. You told me you just interviewed Arthur Laffer, and
Hmm.
I think Arthur Laffer is most famous for the Laffer curve, right? There's this
Hmm.
optimal point where you escalate. Same with tariffs revenue. There's a optimal level of tariffs where you can keep gaining revenues, on net without tanking the economy. But past that point, it will be, just a cliff thereafter. You tank the economy, tank the stock market. So for the Republican Party, the key is how do you find that optimal point and by not crashing the economy. And surely right now the stock market, the rally we have seen, which is driven by animal spirits, this optimism, Wall Street believes that Trump is going to bring to the economy. It's very fragile. Just as quickly animal spirits grab onto the stock market, they could leave, depart relatively quickly too, if the administration was not able to deliver. That said, Adam, I still think that despite all the speculations about what Trump will do, all of this stuff would probably arrive in late 2025 or 2026. In the 6 months or so, the drivers of the economy would be the legacy Biden economy. So that's what we are focusing on because I think that Wall Street has been distracted by the US election in the last 2 months. In fact, they have been dismissing signs of cracks in the economy. People like to describe the economy as strong, that Trump inherited a strong economy. But I actually think that Trump inherited a very shaky economy, and the labor market is still cooling. Recent data from census shows that, in fact, non-farm payrolls is overstated by about 100,000 per month this year, which means that we already have seen negative payrolls this year in April, August, and most likely October. So I think those are more relevant in terms of the next 6 months.
Okay, great. You're taking it exactly where I want to take it. So, real quickly, just to summarize what I think I heard you say to make sure I heard you correctly, is if he is successful with his policies, it sounds like you think they will be stimulative to the US economy over the long run. In the short term, we're going to be basically living with the effects of the Biden administration, the Biden economy, for at least through in the mid 2026, if I heard you correctly. And then I heard you say, you're nodding as I'm saying this, so okay, I think I'm doing a good job. And then you said, but this Biden economy is not as strong as reported. And so let's dig into that. So last time you were on, as I mentioned in the intro, you were concerned about rising unemployment heading into the end of the year. I think at the time you had the highest prediction on the street for end of year unemployment. Unemployment, rose a bit after you and I talked, but then it kind of came down for a bit, and it's been, doing okay. And as Powell tells us, who's also the same guy saying this is a strong, resilient economy, he's also saying, I'm not worried about the jobs market at all. What's come down off is just the froth. It's normalizing. This is a healthy, normal jobs market. I'm getting the vibe from you. Nah, maybe not quite so healthy. You talked about the revisions, the downward revisions that we already experienced in the payrolls, right? We found that they were like over 800,000 jobs overinflated. I think that was what through, you tell me,
Through
but it
first
was,
quarter, through first
it,
quarter of 2024. So
okay,
from second quarter of 2023 to 2024 Q1.
Q1, okay. And then there's been a lot of data coming out recently. The latest QECW numbers just came out that suggest we're due for another pretty material downward revision given the data that we now have after Q1. Is that true?
So there's two things, Adam, which is like what the data will show and what the underlying reality is.
Okay.
So the benchmark revisions that BLS publish next February will cover the period of Q1 of 2023 to Q2 of 2023 to Q1 of 2024. And we already know that from early statistics, it looks like that downward revision will be a total of about 800,000 downward revisions to employment. And so the new information that came in since then was the second quarter of the QCW up to the second quarter of this year. That will tell us more about the true realistic momentum because the way that BLS revised down employment data is they just divide the total yearly downward revisions by 12 months and just spread it equally
All
across the
right. So just
months.
very simple. Yeah.
Yeah, very simple, but the reality is the weakness actually is concentrated in a couple of months. And for example, what I think is really happening is that the labor market really started cooling in the fourth quarter of last year, and it continued through the first quarter, second quarter, particularly second quarter of this year. And that was what the QCEW data from last week release shows, that in fact the deterioration was picking up speed. In fact, if I were to think about the true underlying momentum of the labor market, which will never be reported in the official figures until probably 2026, if that pace continue, if there's no improvement in the second half of this year, continuing at that pace would be 100,000 downward revisions per month. Um, so yeah, I think that the labor market was actually quite wobbly, and the reason why the unemployment rate fell the last 2 months. So we have done a deep dive on what happened. We noticed that the unemployment decrease was driven by a massive surge in government hiring. It's just a massive. In fact, it's like one of the fastest monthly pace of government hiring since the 1990s. And it's driven by election related hiring. So whenever you have a very polarized presidential election, we seem to see a surge in government related hiring. So our theory is that the election is actually boosting employment in the last 2 months. And typically, this effect would go away by December. And by January, it would be a meaningful drag on employment. I mean, look, all these election polling workers, what are you gonna do? And all these outgoing Biden administration officials, so, that could number 4,000 people. They're gonna be departing before the Trump people come in. Typically, there's a lag before a new administration is fully, employed. That gap period would be the period where the unemployment rate could rise and could catch up to what should have happened. So what should have happened is that the unemployment rate, and you could see it at the state level data. I mean, there's even though Wall Street typically just pay attention to the monthly non-farm payrolls that's released on the first Friday of each month, later on the BLS would also revise the state level unemployment and employment data. So looking at those state level data, what you actually see is that the unemployment rate is actually on a very persistent upward climb throughout the second half of this year without relenting at all. And in fact, when you sum up the state level non-farm payrolls, it was clearly negative last month, and it is not due to hurricane. It was due to other cyclical factors. So I think markets have completely dismissed these data, thinking they're just distracted by the U.S. election.
All right. Can I just ask a question on top of that? So you're saying the data that you're looking at is suggesting that the jobs market is continuing to deteriorate the more we've gone into 2024. And you're putting aside the impact of the hurricanes and stuff that we've had here. So that aside, we've been having this deteriorating effect. Now, giving a boost to the jobs numbers has been all the hiring for the election, right? And those jobs are all going away because the election's now over, right? Now, two questions for you. One is, when you look at the growth in jobs over the past year, really year plus, right? It's largely been government jobs, right? And then the rest is part-time jobs, right? But that big chunk of it's been government jobs. To your point, if you took the government jobs out of some of the most recent numbers, I think we'd have negative numbers looking just at the private sector, right? You're nodding as I'm saying all this. So my question is first one's a little bit of speculation, which is, I think you can make an argument that the Biden administration, coming into an election year, is doing everything it can to kind of make things look as good as possible. And some people have questioned the reporting. Maybe they're putting lipstick on a pig on the reports, but also maybe just the government's been out there just hiring a lot just to try to buoy employment, right? So if that's now over, right? So we may lose that impact, that effect of the government out there unnaturally hiring people. Then combine that with DOGE, right? Which now says, hey, you know what? Not only are we not going to hire more government people, we are going to take a massive chainsaw to these bureaucracies. What does that mean for your employment outlook going forward? To me, I could make an argument that I'd be pretty worried that the main driver of full-time jobs is about to vaporize. Is that being too histrionic?
Well, okay. So first of all, there are not the size of the federal government is not, massive. I believe it's like 2.3 million people out of a workforce of 156 million. So even if Elon Musk were to fire everybody, that's still a droplet in terms of what it would do to unemployment. Not to mention that in Elon Musk's Wall Street Journal op-ed, he mentioned giving out 2 years
A
severance
healthy
to
severance,
go
yeah.
right. So
Yeah.
that should support consumption, even with the firing. So I think that the Doge, in terms of its movement on unemployment rate, would be marginal. I just worry more about just this inertial effect that, going back to what everybody was talking about for most of this year, the SOM rule. What the SOM rule says is there's this statistical regularity, which is that when unemployment rate climbed by over 0.5 percentage point in the past 12 months, then it is going to go on a trend increase. And I still have not found a lot of convincing reasons why it should not be that way, particularly now that the election is over. And I'm seeing more and more of that in the data as well, that I think I think that Wall Street just have not paid enough attention to the underlying drivers of uh, the weakness in non-farm payroll.
Okay, and as I've said many times on this channel, so I won't bring it up here again visually, but when you look at a chart of the unemployment rate, historically, it always comes down after the last recession, and then it gets very quiet, and then it starts moving up, and then very quickly, usually it spikes, right? That's kind of its traditional pattern. That's why everyone's so worried about the Somme rule having been triggered, which is, oh, are we about to go into one of those big spikes here? Um, I would think, and this may be too simplistic, but I would think that you would expect to be seeing sort of at least the initial signs of weakness in corporate profits to really get worried about this. Are we seeing any of that at this point in time?
Yeah, I think the corporate outlook, profits outlook seems too rosy to me at this point. I think it's for sure there's some consumption is being supported by the top 20% of household, and the top 20% of household by income, they generate about 40% of consumption, and those people are still spending. Maybe more of them are trading down to Walmart, and
Hmm.
typically, for example, we have seen Walmart's profit guidance being very robust, right? That is not a good sign typically. And the way
Right.
if
And,
you
and,
look
and
at the
sorry to interject, but
details,
we're seeing at the same time, other retail stores like Target and whatnot get clobbered, which is also a sign of weakening consumer spending.
right? And also budget stores like Dollar Trees are also being clobbered because
Right.
those guys are moving to, I don't know, food banks.
Right, because
So
that's the bottom 80% really getting the
right,
hard time, right? But
right,
you're
right,
saying
right.
we're starting to see a weakening of the top 20% that's kind of been carrying the averages, right?
Yes, yes, yes. And the top 20% in turn is supported by wealth effect from the equities market. And going back to my earlier point, then the stock market is supported by this animal spirit, which arrived very quickly and it could depart as quickly. It's basically like, this uh, chicken and egg problem. Like you go back to the fundamental of the economy. And the question that we should be asking is, what is the thing that's really supporting all the spending? And the
Hmm.
answer is it's the labor market. So so this is why we spend a lot of time in forecasting and looking at the details of what's been driving non-farm payrolls and unemployment and what is that trajectory. Because ultimately, consumption is not the thing that leads a recession or a downturn. In fact, consumption barely usually falls, especially in services, barely falls in downturns. So it's kind of pointless from a forecasting perspective to be looking at retail or consumption to think about what will happen next. What really matters is the labor market.
Okay, and you are concerned about the trajectory that you're seeing in the labor market here. Um, okay, so I want to connect this to the financial markets right now. So by a number of metrics, they are either very richly valued, or they're the most richly valued they've been in history, right? If you look at things like the Buffett indicator, or the percent of the S&P, the ratio of the S&P to world GDP, they're at like ratios they've never been at before. PE ratios, cyclically adjusted PE ratios, are they're not at their highest extreme, but I think they're at an extreme that we've only seen once or twice before in history, right? So they're very richly valued. You're now looking at the labor market and saying, okay, I'm getting concerned, right? Um, Now you talk to people like, well, you listen to Trump, obviously, but even talking to somebody like Art Laffer, who thinks, oh, if Trump pulls us off right, we can see almost immediate impacts from some of these, big economic reforms he wants to do. He's not that worried about, certainly not an economic slowdown, but also not that worried about markets. In fact, he says that I can make a good case that we're at the start of yet another big bull run in the markets for the next 5 to 7 years. Um, Do you share that level of sanguineness, or are you a bit more concerned about current levels of valuation and the weakening that you're seeing in the jobs market?
Yeah, Adam, I think this gets back to, I think a key question to answering your question here is what actually happened in the past 12 months and what actually happened in the past 2 months. Because even now, we economists are still debating, was the economy great? Is this a strong economy?
Hmm.
Are we in the middle of a productivity boom unleashed by Bidenomics? There's an alternative way to interpret this, which is that, in fact, the economy was in the midst of a downturn already earlier this year. I mean, there's a academic paper by Emmanuel Sias that puts the probability of a recession at 40% starting April 2024 this year. So I mentioned that QCEW suggests that almost surely non-farm payroll was negative this April, right? Usually that's a telltale sign of a
Hmm.
recession. So I know that this is a controversial topic because a lot of people want to say there's no recession, look at GDP, but even ChatGPT can tell you that labor market data is superior and more reliable than GDP data, and GDP will take 5 to 10 years to be revised ultimately.
Right.
And if you do think that non-farm payroll is going to be revised by 800,000 last year and a million this year, obviously there is going to be some revisions to GDP in the future, right? So I actually for me, I have downweighed the signal from GDP. I'm just putting a lot of signal on labor market, and the labor market tells me that it's possible and plausible that the downturn actually started already. But the NBR, Business Cycle Committee, probably won't be calling it until 2 years later when all the revisions are done. By
Yeah.
then, we would be in the middle of a recovery. But let's entertain that hypothesis. Suppose that a downturn actually happened late last year or early this year. So by the middle of next year, you'll be in the middle of a recovery. However, usually unemployment rate continues rising even like after the NBR recession bars are in place, you know?
Hmm.
So it's actually and also typically in a recession, you do have productivity surging, and that's exactly the contour we have been seeing. My explanation for why we have seen a productivity growth increase in the past year was, I think, is purely cyclical. I see very little being driven by AI or any structural or Bidenomics. If anything, I think Bidenomics, the government, the enlargement of the government sector is dragging down productivity. So I think the contour of the improvement of the productivity is actually consistent with a mid to mid like downturn dynamics. So all this is actually consistent with what Arthur Laffer is saying, as you were suggesting, that it could well be that by late next year, this unemployment will be rising because of this legacy effect, but everything else could be picking up because the cycle could be over in that sense. It's
Okay.
possible.
Okay. I ask these questions largely for two reasons. One is to help the average person just sort of prepare for what's coming ahead, right? And so if we are worried that we could see a material spike in unemployment, I just want folks asking themselves, okay, am I vulnerable to that? Are there steps I could be taking now in case I end up getting a pink slip, whatever? It sounds like, and I'm painting with a very generalist brush here, so feel free to correct this anyway. It sounds like you're saying, yeah, maybe that's a good question to be asking yourself, given the fact that you think the unemployment rate could be going up. The other reason why I ask these questions is because this is a wealth building channel. There are people here who are, retail investors who are trying to surf whatever, is likely to come in the future here. And they're trying to answer the question, because I have people on here, like you said earlier, Anna, they'll look at the smart people, look at the same data, come to very different conclusions. We're heading into a recession, or no way, this is a great bull market, right? So they're trying to answer that question of, okay, well, is it an overpriced market that's at risk of a decelerating economy and I got to take chips off the table and be more defensive? Or are we at the start of, did these animal spirits that got reignited here, is that just the beginning, right? So do you have an opinion right now heading into 2025 on which side of that spectrum you fall more
Yeah.
on?
Yeah, I think the chance of a downturn already happened is higher than a downturn to be happening, in
Okay.
the
So is
sense,
that good
but
news then?
but in terms of the feeling, the feel, because the what matters to people are not economists talking about when the recession has happened.
Right.
What matters to real people is the job security, right? And as I said, Adam, typically unemployment rate keeps on rising after a recession is over. And so for the common people, it's not consoling to say, oh, the recession is over, that the probability of us slipping into a new recession it has decreased. No, for them, what matters is the unemployment rate gonna rise? So those two are very different questions, whether we are slipping into a recession versus is the unemployment rate going to rise, right? Because it has been rising
Yep.
for most of this year. And also the second question most people want to care about is the stock market overvalued? How's my 401k?
Right.
What's it gonna do? So for that, I would, since I'm not an equity strategist, I would refer people to looking at, thinking about how stock market usually respond in late downturn kind of situation. So because I think, so my base case is we are in kind of like already through the downturn in terms of you know uh, in terms of GDP, I would
Hmm.
say. But in terms of the labor market, is still experiencing that, downturn dynamic inertial force, and it's the one of the most lagging economic indicators. So we could be still seeing this trend increase in unemployment. So how the stock market would react to that divergent forces, late downturn versus, some animal spirits unleashed by Trump, and also this inertial deterioration in the labor market.
Okay. Well, let me ask you this. The stock market, in theory, is sort of supposed to sniff that stuff out in advance and reprice before we hit the peak in the unemployment rate and stuff like that. Um, Clearly, that's not happening right now. Do you feel like, and I think maybe you do, given by some comments you mentioned, but I don't want to put words in your mouth. Do you feel that the market is just ignoring it, has been ignoring it to date, and is going to have to reprice as a result of this? Or does the market just have a different thesis?
So I think in terms of market signal, I would put more weight on the bond market, because the bond market tends to be the smart money, I would
Mhm.
say. And the bond market did sniff out these weaknesses. I mean, before September, bond yields, 10-year yields were what, 3.8, 3.6.
Yep.
Um, and in fact, Powell himself was actually describing the labor market in quite alarming terms as of September, and that was the reason why he had to
For
cut by
Powell,
50
yes.
basis. Yes, for Powell. And the bond market sniffed that out. They were like, wow, the Fed is worried. And fast forward 2 months later, Stanley Powell is talking about strong economy. We have economy in good place. We are not in a hurry to cut rates. And I think the bond market is sniffing it out too. But most of all, going back to something I said earlier, which is that I think the bond market, smart money, is distracted by the US election and didn't spend enough time looking into the labor market details. And the in a way, the US election is like a red herring, or it's kind of like an Australian shepherd going on a walk, seeing a bunny and chasing after it, when in fact, it should be looking at following the scent of the details of the labor market.
That's a
And I
great
think
analogy. I'm going to
I
use
think we
that.
are
Replace
about
red herring with Australian Shepherd. It's great. It's really applicable.
So we are actually at this point now that Scott Bessent is nominated. I think people are starting to really take a look at what's plausible, and they're now starting to focus on the fundamentals, because they're like, okay, so maybe Trump policy won't be that crazy after all. So it comes down to the fundamentals, and I think that in the next couple of months, people are gonna spend bond market is gonna spend more time looking at the labor market, that and the beige book, we're getting both of them in the next couple of weeks, instead of speculating on something out of thin air,
Got it.
which is
Yeah.
hard to predict.
So let me ask you this. If the bond market becomes more worried, do you expect rates to go up because bondholders want compensation for greater risk? Or do you expect, at least in the treasuries, yields to go down because you start having a safety trade? I'm worried, and at least a treasury is a good place to hide out.
The latter, the latter,
Yeah.
because I think the past 2 months have been dominated by the former effect, the Trump trade, was the worries about inflation, worries about fiscal worry. Well, it turns out that now that we have the election, we have seen a lot of fiscal hawks coming out from the Trump administration, Elon Musk and
Mhm.
Scott Bessent, and then we are now seeing weaker data. I mean, that combination should cause the Trump trade to reverse in the next couple of months.
Okay. And you talk about we're going to be, kind of living with the Biden economy for the next year and a half. We'll be continuing to live with Jerome Powell, who was actually appointed by Trump, but they've had their falling out. Powell's likely not to get renewed, in 2026. If things play out the way you think they will, with the labor market continuing to deteriorate and whatnot, does that make you think that Powell is going to be continuing to cut because that's a sign that, hey, I need to step in, or will other concerns potentially have him stay higher-ish for longer?
Yeah, so I think the base case is definitely the Fed will be cutting, but the issue is how fast would they be cutting? So only in an extreme scenario will the Fed be hiking by the end of 2025. So in this extreme scenario, so by the inertial Taylor rule, I've seen that the unemployment rate needs to be falling to 3.9% and core PCE inflation rising to 3.6% for the Fed to be hiking at the end of next year. Now it will be extremely difficult for core
Hmm.
PCE to be rising from the current 2.7% to 3.4% by the end of 2025, barring some pandemic-like situation. So the base case definitely is cutting. The question is whether the Fed, I mean, the fastest justification for the Fed to hold rates higher for longer and refusing to cut even in the midst of a climbing unemployment rate is if they say the R star, the neutral rate, is higher. It's almost saying nothing at all. Because to me, R star is tautological. It's like,
Hmm.
so we are not cutting because of this invisible thing that nobody can observe, and we think this invisible thing is higher, and therefore we're gonna. That's almost like that's so easy to attack as being politically biased, right? If you're a
Hmm.
science, whereas especially if this is happening in the midst of a climbing unemployment rate. So I think the crucial thing for the Fed is will Powell respond to the data, the unemployment data and employment data as they did this year, which motivated them to cut by 50 basis points in September? Or is the reaction function going to change because they're appealing to the higher R star? Because I see if my unemployment forecast comes to pass, which is that it will continue to gradually rise next year, and yet the Fed is only cutting, pause or decide to pause rate cuts in the coming in January or in December, then I think that the reaction function has indeed shifted because of this R star argument, and that pose a risk, further risk of amplifying any downturn dynamics in the economy, because then the Fed would be overly restrictive.
Okay. Okay. And that wouldn't surprise anybody because the Fed has the reputation of always being behind the curve and acting too slow. All right. Do you remember off the top of your head what your unemployment estimate is for the end of 2025?
Yes, we have the unemployment rate, I think, averaging 4.5 by fourth quarter of 2025,
Okay.
I believe.
All right. Well, look, Anna, we'll have you back on hopefully plenty of times between now and then so you can make audible adjustments as and if needed based upon the data as it's unfolding there. All right, I'm going to wrap up here, but real quick, I'd love to give you an opportunity just to opine for a minute about, I think last time you were on, we talked a bit about something that's near and dear to my heart, which is just the average consumer and how things are likely to go for them going forward from here. And they've had a rough couple of years in general, right? Um, Huge spike in the cost of living. The bottom 80% who doesn't really own financial assets, they've gotten all the pain. They didn't get much of the gain that the wealthy 20% did. And you talked a little bit about that already. So, you're an economist, Anna. You're one of those people that just spends all their time in the data. And, oftentimes people will say, well, the economists don't really get the real world. But you're a real person, you're a mom. I've had discussions with you. I know that you're a real person who lives in the world. Do you have any bit of parting counsel just for the viewers of this channel who are regular people about the situation of the consumer going forward as you expect it?
Yeah, Adam, I appreciate that you don't think I'm an AI or a bot.
Fair enough. And I
Yeah,
don't think of
so
you as a
I
dusty academic either. So,
yeah, so I would think it would get worse before it gets better. Because if so the Trump administration is coming in with this mandate to improve the economy by lowering prices, um, right? And the way that they have just their economic vision is to do so by cutting government spending, cutting government transfers. So part of that would involve, for example, no longer extending the forbearance on student loans,
mhm.
which the Biden administration have been kicking down the road. What this means is would be higher, the credit scores would worsen for a lot of you know, people in between age 20s to age 40s. So, and then at the same time, they are promising that, that they might be lifting the caps on medical prices. So some people may also see medical services prices going up. But at the same time, they are promising that by cutting the government spending and deregulating, they could usher in stronger growth in the future. So this kind of economic vision, if it were to play out, necessarily involves a near term pain. And Elon Musk promised that in the Wall Street Journal op-ed. He said it will get painful before it'll be great. And so I think this it could get painful in the first 2 years, and then in 2027 and 2028 things might improve. So
Okay. I'm glad you brought that up. You're the first person I've interviewed in the past week and a half that I actually haven't started the interview with that question, which is assuming for a moment that Trump is successful with his main economic policy goals, can we get from here to there without some pretty material short-term pain? Almost everybody has said no, they don't think we can. Sounds like you're in that camp too. The only potential exemption is Art Laffer, who is just crazy optimistic about where things are going. But it sounds like you say, hey, people should, you know, eh, their default should be it's going to be tougher sledding before it potentially gets better. Sounds like you're sort of like me that if you were advising the Trump campaign, you would say get that messaging out there. Otherwise you might find that you don't do too well in the mid-year elections because people haven't seen the benefits yet and they feel like they were kind of lied to about how amazing everything was going to be. So, anyways, I appreciate you putting it all out there. So, Anna, always a pleasure talking with you. For folks that would like to follow you and your work in between now and your next appearance on this channel, where should they go?
well, you could go on my Twitter account at Anna Economist, or you could, if you have a Bloomberg Terminal subscription, then you can go on Beco Go, BECO Go, and then you can read all about Bloomberg Economics analysis of the economy.
Great. And Anna, when I edit this, I'll put up links to those on the screen. Folks will also have the links in the description beneath this video. All right, Anna, stay with me for 30 seconds because I want to give you the last word here. Folks, if you've enjoyed having Anna on and would like to encourage her to come back on the program as soon as anything material changes in her forecasting, please let her know by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. If you would like some help in figuring out how to position for the future road that may lie ahead with your portfolio, then highly recommend that most people watching here get that help from a good professional financial advisor, certainly one that takes into account all the macro issues that Anna discussed here. If you've got a good one who's doing that for you, great, stick with them. But if you don't, consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. To set up one of those free consultations, just go to thoughtfulmoney.com, fill out the short form there. Only takes you a couple seconds to do so. Again, these consultations are totally free. There's no commitment. There's no strings attached. It's just a free public service these firms offer. All right, Anna, look, it's been such a joy having you on as always. Thank you so much for coming on, especially during the Thanksgiving week when you've got duties there, both for your work, but with your family. Thanks so much again, and really look forward to having you back on next quarter.
Happy to be here, Adam. Thanks.
All right, have a wonderful Thanksgiving. Everybody else, thanks so much for watching.